Folks, he's back. Yes, Mr. Jonathan Twomley is back. He's been on the road doing deals, having some fun with life in the summer with his family, but he's back. Jonathan, thank you for coming back. How you doing?
I'm great, Michael. I always miss you when I'm away, and I miss the good folks here at RAT. So um, glad to be back. Hey, before we get started, I just wanted to give a shout out just to a couple people. I've had
Sure.
yesterday. I spent a bunch of my Tuesday just talking to investors that had come from RAT.
Oh, cool.
So yeah, so just want to thank you for that, and those people know who they are, and I just want to thank them. I had a really good time talking with you guys, and so I encourage everyone who's here and who's accredited to come and join my platform and get in on future deals, and get me on the phone. You can actually talk to me if you want to. It's open to all investors who want to talk to me. Just get on my list, and my assistant will send you an invitation to get on the phone.
Yeah, folks, Jonathan, you can go back and look at his playlist. He's been with us for several years now. He just brings the truth. He was one of the first ones to warn about the apocalypse that's coming to commercial. He and I both sold admittedly early, but it was the right decision with the information we had at hand. And now, frankly, he and I are salivating on the opportunities that are coming. Pay attention to video number 3, more on that in a minute. But where I want to go first, Jonathan, is something that I have been saying. I believe it to be absolutely true, but you are in the game far deeper than I am in syndication and in big deals. So I wanted to see how this statement felt to you. Are you ready?
Sure.
We have a lot less billionaires today. I've gone back and looked at billionaire lists, and a lot of them are billionaires because of the real estate that they hold. Yeah. Commercial, office, retail, warehouse, multifamily. And I think with what we have seen with cap rates, what we have seen with rent and just all of these things, there are frankly less billionaires today, probably a significant percentage, 20, maybe up to 20% less billionaires today, if they were forced to mark to market. What do you think of that statement?
Yeah, I absolutely agree. And I agree with this. Well, I mean, statement makes sense to me, but I'll tell you where this especially hits. Now, up until March of 2020, there is almost nobody who would have disagreed with the statement that downtown core office property is the blue chip property. Like that is the
creme de la creme.
That is the best possible thing to own in the world, is core big city downtown office buildings. And multifamily, believe it or not, was until fairly recently seen as kind of like an alternative asset, right? You had like some insurance companies owning it and stuff, but it was not really seen, until 10 years ago as being kind of like a blue chip asset the way people think about it now, right? What people who had money, what the big guys bought was office buildings. That's what they wanted. And the bigger, shinier, higher quality tenant, the better. So the creme de la creme, that, and nobody, if you talk to them in January 2020, would have ever said there is any circumstance, they would say there is no condition imaginable right now under which 3 years from now, those will not still be the best property to own in the world, right? And so billionaires disproportionately were owning those assets. And those assets, as we talk about in the last video, have cratered in value. I mean, you guys all know this if you follow us and you follow the news. You're in real estate, so you understand what's going on. But we're going to show you mathematically why that's true. Yes. So to the extent that they were, holding a lot of office buildings, absolutely true. And to some extent for multifamily too, if they bought at the height of the market, they're also down by a quarter.
Well, we know there are some, I don't know, social media types. Maybe they're not billionaires today, but they kind of put on that front, who were bragging about buying multifamily at 3.5 caps.
Yeah.
Even if they have agency debt and they have the time on their side, so maybe they can get through it, their expected IRRs or yields are going to be nowhere close to what they were forecasting. And I fear, and And there was one, I'm not going to name him, but one social media guy who built his name up, and he's done about $1 billion in deals over the last 2 years. I've seen some of them. I'm an accredited investor, right? I'm on your list, so I see these deals he's doing. He did them with bridge debt.
Oh yeah.
And there's a chance that he loses half his portfolio. And again, it won't hurt him because I'm sure the debt's non-recourse, but it's going to blow up all of his LPs. So I think there's a lot of people that claim pretty fancy net worths that are probably worth zero and maybe even negative if they had to mark to market. It could be bad out there.
Yeah, absolutely. And I mean, so bridge debt, we've talked about this before. People were doing bridge debt over the last few years because it was the only way to compete, right? And one of the reasons that I didn't even really bother looking at multifamily a couple of years because I didn't want to ever take bridge debt on one of those deals, right? It was floating rate debt. I mean, bridge debt, fixed rate bridge debt is fine. So let's not cast too wide a net.
Sure.
We're talking about floating rate bridge debt, right? Yep. And it was the floating rate bit that really scared me. And there were a lot of people telling me I was wrong. There are some.
You don't get it. You're old. You boomer. Yeah.
Yeah. And I'll be honest. I mean, there's some really sophisticated people who do floating rate debt because it's more flexible. And those people plan ahead, right? And they weren't the people who were thinking about it in that kind of way are not like overpaying for property and using fixed, floating rate debt to get like a couple more basis points of return or whatever. I mean, they're using it as a planning strategy and they're hedging appropriately. But that wasn't what a lot of people were doing. They were just using floating rate debt because they could get a slightly better interest rate that allowed them to make a stronger bid for the deal because it was all about getting the deal because they all of them made their money on acquisition fees.
Yeah,
right?
and they had teams to feed. That's the problem with the model that we had over the last 2 years, is it was all about getting a bigger and bigger team, so you had to get fees to pay them, and that's where people went downhill.
I don't want to get too sidetracked, but since you mentioned this, when I started in the business, you would routinely hear about these old school guys with like these enormous, $100 million, multi-$100 million portfolios. And it was like 3 people, right?
Yeah.
It was like 3 partners and a secretary. And that was how they ran their business, right? And they weren't, and the reason for that was because their investors were institutional investors, family offices, extremely high net worth people, and they put together a deal with 4 or 5 of those groups and they were doing syndications, but they were not marketing to, hundreds and hundreds of $50,000 LPs. And when you get into that business of marketing to hundreds and hundreds of LPs, you have to have a whole marketing team, right? And you are spending a lot of money on ads, social media ads, and podcast production and all this other kind of stuff. So a lot of these people had these enormous teams to feed, right? And they weren't getting any cash flow from their deals because the sponsors sit at the, they last in those deals. So they were basically getting big acquisition fees, a little bit of asset management fee, really, we call it keep the lights on money. It's often barely that. And then the promote on the end. And it was all about churning those deals fast and just feeding the machine. Now you can't, it just creates bad incentives, right? When that's your model. And I never was interested in that model. Of course, like every once in a while, I look at these guys and be sort of jealous and go, man, they're doing such big deals. They're doing so many deals. Like, what's wrong with me? But I wasn't interested in building a huge team. And I wasn't frankly interested in creating a job for myself. It wasn't why I got into business, right? I created the business. I got into the business to have freedom, not to have another job. And I think a lot of these guys created just a new hamster wheel. It's just a different hamster wheel.
No, I mean, again, over the last couple of years, and again, the reason I still speak at events is because I want to know what the audience is doing, because it becomes the thing that I run away from. 2 years ago, I've told you this before, I was at a San Jose event where everybody in the room was a new syndicator, which was really dangerous. I'm in the Silicon Valley. Back then, there was a lot of stock market wealth and all of that. And these complete rookies were raising millions of dollars. And I was like, I know how this is going to end. Then there was the whole Airbnb kind of, you can't miss with Airbnb. You boomer with, long-term rentals. You're an idiot. I'm like, I know how this is going to end. And again, it just became easy money that attracts other easy money, and it worked for a little while. But I knew the party would end, and it's going to end spectacularly.
Yeah.
And a lot of people are going to get hurt.
Sometime on this channel, what I would like to do is bring back my old market psychology, and that's
Ooh.
psychology, right? Lecture that I used to do, because it really plays into this, and I used to talk about this a lot back in 2017, 2018, when I thought the market was getting overheated and nobody really wanted to listen to me. But I think it's really important to kind of understand how investor psychology plays with the market, and how it's always the fact that when most investors believe it's safe is when it's most risky, right? And
Agreed.
vice versa. And so what you have is this, like on Silicon Valley, you get a couple guys who kind of discover the syndication thing, right? And some of these the gurus of the big syndicators are like, hey, you can raise money for me. So they start going to all their rich friends in Silicon Valley, and one guy makes money, and then they all start piling in, and then people get FOMO and more pile in. And what happens is that people keep on making money and making money, and that lulls everybody into a false sense of security. And that's when it gets the most dangerous. But that's also when, if you tell somebody that it's getting, that was the time that they should be most careful, they
don't want to hear it.
They look at you with daggers in their eyes, right? I mean,
you got 3 heads. What are you talking about?
Yeah, well, not just that. It's like you threaten them with something that, and like they get very angry. I mean, people were like,
oh yeah,
angry with me when I was saying like stuff like, "Hey guys, like maybe you should like be a little more cautious." Like
hey, what are you doing?
You say it nicely, and they're still angry with you, right? Because threaten the good times. But
we're going to get into some pretty meaty conversations next. I do think there's less billionaires. I actually think there are some billionaires that are going broke. Just to kind of catch you up, I don't know if you stay up to date with what's going on with Billionaire Barry, but obviously Billionaire Barry earlier last year lost a mortgage company to bankruptcy. He stopped paying dividends or distributions on his REIT, and then most recently, to raise cash, he sold 1,900 homes to Invitation Homes, because Invitation Homes gave him $450 million in cash. What I think a lot of billionaires are going to do is what Barry is doing. They're going to look at their portfolios, Jonathan. They're saying right now, I'm going to let these ones go, and I'm going to protect these ones. And now when I say billionaires let these ones go, they're going to be willing to hand the keys back. I think it's going to be negotiations, because again, if the bank or lender believes they're good for it, they may extend and pretend. But I think billionaires right now, like Billionaire Barry, are like, I'm going to protect these, and I'm going to risk losing these. How's that feel?
Yeah, I agree with that. I mean, I think that's what always happens. They're looking at their portfolio and thinking, okay, what do I think I want to hold in the long term, even though right now it's maybe distressed, or the mortgage is upside down or whatever. But I believe in the long run this is going to be valuable. And then they got to look at what they've got to sell, or what they to prop it up. And oftentimes what they sell is what they can sell, and what they can sell is like there's one of the strongest performing assets, right? So the grant community is probably the only thing of real value that had to sell.
Exactly the point. Exactly. That's why everybody's saying Barry sold homes because it's the top of the market. No, Barry sold his homes because it was the only thing that could get cash. It's the only liquid thing he had. He is very, I'm guessing, illiquid. He might be a billionaire. I don't think so, but he's very illiquid billionaire if he is one. So he raised cash. That's what he's doing. Yeah. So Jonathan, where can people find you, and talk about your Facebook group that people should join?
Yeah. So come to the Apartment Investors Club. If you join the Apartment Investors Club, I've forgotten to mention this in the past, but when you go there is a free 4-video series inside about how you find deals, how you raise money, how you syndicate. And it's a really good introduction to all of those topics. So it's just sitting there in the group, in the file section or the video section, or I forget where it is, but join us and get that for free. It's a really good resource And that's just at Apartment Investors Club on Facebook. So
Awesome.
please join us.
There you go, buddy. And let him know you came from ORAT. He loves seeing you guys join. Thanks, Jonathan.
Absolutely.